Hey traders, Todd Gordon here with TradingAnalysis.com. This is for CNBC's Trading Nation. Traders, today I want to take a look at a setup in Google. We're going to go shopping here for Black Friday deals and Cyber Monday and Small Business Tuesday and all these different deals. Google's a stock that has performed relatively well. It's on sale here in this market pullback, so let's accumulate some Google. If the market resumes the uptrend, Google should do just fine on the top side. So the first thing you'll notice is the implied volatility has come off here in Google following the earnings in October. That makes all options, both puts and calls, relatively more cheap than they were prior to earnings. So we can use that again to buy cheap options. As we go from the daily, let's really zoom in here. This is going to be a little bit of a shorter term trade in Google. What I like about this is you can see a nice three-wave correction. This is the signature look of a corrective move that will indicate that the trend is continuing to the upside. So we have a nice three-wave move. On top of that, another little chart pattern you'll see is we have an inverse head and shoulders here. You've got a left shoulder, you've got a right shoulder, and you've got a head. So that's basically a bottoming formation that should offer kind of a launching point to continue to the top side. Finally, we're really going to work on this chart. We have a downtrend resistance that just was broken right at about the $785 mark. That was resistance. It was broken, flips to become support. That's our launching point. So it looks like Google should be able to move back up into the 820s, 840s, maybe even 850 here over the coming weeks. So let's go to work, pick up some cheap options following the implied volatility drop in earnings in Google. So what I'm gonna look to do is let's go ahead and see if we can do an 820, 825 call spread. I'm just going to take us above the most recent highs by a little bit of an out of the money call debit spread. That'll take us just through those highs. And once you break out, that's when you want to start taking profits just above that push of 820. So we'll go ahead and buy the 825 call spread. The other reason I want to do this is if we fail at this old high, the call spread that we will purchase will have increased in value. So we can also book profits if we fail at that old high. So let's go over to Google. Let's give ourselves 19 days should be just fine for this trade. So we'll be trading the December monthlies. We're going to buy the 820 calls, sell the 825 calls. All together, it's going to cost us $1.25, which is $125 per option spread we're trading. That's our total risk. That's all you can risk in this trade. And the top side will be capped at $375. So a nice positive reward to risk ratio. Now, I always like to scale back at a 50% stop loss. So if the $125 premium that we outlay here drops down to, call it, 62.5 bucks, then we want to get out of this trade and contain the risk. All right. Always consider the risk before you start getting wrapped up in the reward. So review order, place the trade, and it's working. All right, guys, that is the trade in Google. For CNBC's Trading Nation, I'm Todd Gordon. Be sure to follow us at Trading Nation on Twitter for updates on this trade, as well as all the other ones. Good luck trading, and we'll see you in the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.